Good morning, students. So, let us start with the next subtopic, that is valuation of bonds and shares. Now, to understand valuation of bonds or shares, we need to understand something called as discount rate. Now, the discount rate or the discount factor, it is a percentage which represents the time value of money. Basically, it helps you to determine whether time value of money exists or not. In our initial class, we have seen that the main factor, the reason for which there is time value of money, is interest. Now, to calculate this discount rate for the cash flow, you need to know basically what is the highest interest which you would get if you would invest that same amount somewhere else. As we know that interest rate is the main reason which causes time value of money, and that is why discount rate needs to take into consideration that interest. So basically we can say that discount rates, which are also known as discount factors, are used by the investors to translate the value of future investment returns into today's returns. That is basically it is used by the investors, the discount rate is used by the investors to understand the present value of future returns. Now, what is the formula of discount rate? It is given over here. It is 1 divided by 1 plus r the whole raised to n, where r is the rate of return and n is equal to number of years. Discount rate. Moving ahead, let us see what is bonds. A bond is basically a contract under which a borrower promises to pay interest and principal on specific dates to the holder of the bond. So basically, a bond is nothing but a sort of a loan which is taken by the company from the general public, and now the company has to pay back the principal amount along with the interest on specific dates to the general public. Moving ahead, bonds, it can be redeemable or irredeemable. Redeemable bonds are those which will be repaid to the supplier of the debt after a specific period. That is, the company will repay back will repay back that debt or repay back the loan which they have taken from the general public. That kind of a bond is redeemable. But there is something called as irredeemable or perpetual bond. This type of a bond, the company does not pay back to the general public or does not pay back to the lender. They only pay back the interest amount and not the principal amount. It is kind of equity, like in equity how you get, dividend. Over here, the general public, whoever have opted for this irredeemable bond, will get interest but won't get the principal amount. So this is basically like a broad classification of type of bonds, that is redeemable and irredeemable. Moving ahead to the different types of bonds, in order to solve the problems, it is very essential that you all know what kind of a bond we are dealing with. So the broad classification, as I told you, is redeemable and irredeemable, but there is something called as zero coupon bonds as well. Now, zero coupon bonds is nothing but coupons means what? Coupons means interest. Zero coupon bonds means what? Bonds without interest. So bonds which does not give you coupon, they are basically zero coupon bonds. They are issued at a discount and redeemable at face value. Since they do not provide interest, now definitely there should be some benefit. Otherwise, why would investors invest? Isn't it? So they are issued at a discount and redeemed at the face value. That is, example, a bond of 100 rupees will be issued to you at 95, and at the redemption, that is, when it matures, you will get 100 rupees. Okay, so you are buying it for 95 and at the end you are getting 100 rupees. So the total profit for you is 5 rupees, which is going to be your return. Moving on to coupons. Coupons, again, it is divided into two, that is fixed and floating bonds. The fixed kind of bonds are again classified into four. But what are fixed coupons basically? Fixed coupon bonds are nothing but where the coupon or where the interest amount is predetermined at the date of issue itself, those are called as fixed coupon bonds. And what are floating coupon bonds in that case? Floating coupon bonds are bonds whose interest is not fixed at the date of issue and whose interest depends upon the future market rate of interest. And we cannot determine the future market rate of interest, isn't it? Because the future market rate of interest depends on various external factors which are not in our control, which we cannot control. So that is the reason why it is impossible to calculate the value of floating coupon bonds. So we are not going to venture into that. Moving on to fixed, I'll repeat again, fixed is nothing but those coupon bonds which the coupon rate is determined at the time of issue itself. Okay, now let us come to the last one, that is the perpetual, and then let us move into the broader classification of fixed coupon bonds. Perpetual is, as I told you, another term for irredeemable bonds. In case of perpetual, the investor won't get any principal amount back, they are just going to get some amount of interest. Moving on to the fixed, different types of fixed coupon bonds. There's first one which is the plain vanilla. The coupon remains constant in case of plain vanilla. That is example, 10% is the coupon, say 10% is the interest rate which is promised to you by the company at the time of issue. They said that they will pay you the 10% for a period of 5 years. Then for the 5 years constantly they are going to pay you 10%. That is plain vanilla. Then what is non-plain vanilla? Non-plain vanilla is nothing but the coupon rate will keep on changing. Now don't mix non-vanilla with floating. Floating, the market rate will keep on changing, but it will be determined based on the future market price. Whereas in case of non-vanilla, it is determined by the company that the coupon rate will keep on changing. That is for the first 1 year, they are going to give you 10%. For the next 1 year, they are going to give you 12%. For the third year, they are going to give you 15%. So at the time of issue itself, it is determined that the interest rate is going to change, that is the coupon is going to change, and at what percent the coupon is going to change is also determined at the time of issue itself. That's why it is non vanilla and it is coming under fixed. Okay, whereas floating, you don't know only what is going to be the coupon rate because it is going to be based on some market interest rate in future, and we cannot determine the market interest rate what it will be, whether it will rise or whether it will fall in future. Coming to the next, that is callable bond. The bond is called callable bond which can be redeemed by the company at any time before the maturity. The maturity is 5 years, say the company can redeem it any time before that 5 years, then it is callable bond. Example, 5 years bond can be redeemed in say 3 years itself. So that is a callable bond. Whereas the next one, that is the putable bond. In case of putable bond, the bond can be redeemed by the investor anytime before the maturity. In case of callable, it was the company who could redeem the bond at any time before maturity. Whereas in case of putable, it is the investor who can redeem the bond at any time before the maturity. Callable bond, it does good to the company, whereas the putable bond does good to the investor. Okay, so these are the different broad categories of types of bonds. Moving again, moving forward to the features of bonds. Okay, so the first feature of bond is the face value. Face value is called par value as well. So a bond is generally issued at par value or something called as face value. Okay. Moving on to the next term, that is interest rate. As we know that interest rate is the basis for time value of money. If interest rate does not exist, there is no time value of money. It is also called as coupon rate. Okay. So it is interest which is paid on a bond and it is tax deductible as well. Maturity, as we know that most of the bonds are redeemable and hence they also have a maturity. Then coming to redemption value, it is the value that the bondholder will get on maturity. It is called as maturity value. So it can be redeemed at par or at premium or at discount. So it depends what the redemption value will be. Moving on to market value, a bond may be traded in stock exchange. The price at which it is currently sold or bought is called as market value of the bond. Now the market value may be different from that of the face value or the redemption value. So these are the different features of the bond. Moving ahead to valuation of bonds. Now, as I told you all that a bond is nothing but a loan which is given to the general public by the which is taken by the company from the general public. So bond is nothing but a loan which is taken by the company from the general public. Like a loan, like a normal loan, its value can be determined on two bases. That is, the first is the interest and the second is the maturity value. How much interest is an investor getting over a period of that time for which they have given the loan to the company, plus at the end of that period how much amount will they get, how much principal amount will they get at the end of that maturity. That value is called as redemption value. It can be redeemed at par, at discount, or at a premium. Moving ahead to the different formulas with which you can calculate the value of the bond. The first is bond issued for a year. As I told you, it is a combination. The value of bond can be determined based on the coupon and the redemption value. So the coupon and the redemption value is discounted. As I told you all initially, discounting it helps you to find out the present value of the future returns. So basically in valuation of bonds, we are trying to determine what is the value which we will receive after a set period of time in future. What is the present value of that amount is determined using this formula. That's why you will see that for all the formulas we are discounting them. Why are we discounting them? Basically we are discounting them because we need to know what is the present value of those future returns. Coming to redeemable, the formula remains same. Since over here the period is 1 year, that's why n is taken as 1. Over here the period is a finite period. It can be 2 years, 3 years, 4 years, 10 years, 10, 20 years, 30 years. We don't know that finite period. That's the reason why we have taken n over here. Now moving to irredeemable, or bonds which are issued for infinite period. As I told you, in this case only and only the interest amount is paid and the principal amount is not returned back to the investors. That's the reason why the formula is only consisting of the coupon and not of the redemption value. Now over here CI stands for the coupon or the interest, KD stands for the cost of debt, N is equal to number of years to maturity, T is equal to term, and M is equal to maturity value. I hope I hope this basic formulas are very much clear to you all. These formulas will be basically used for the non-vanilla type of bonds which to find out their value. Okay. Moving ahead, let us understand what yield is, because there's always a confusion between yield and returns. Yes, yield is a return, but it is in terms of percentage and not in terms of amount. There are basically two types of yields, that is current yield and yield to maturity. What is current yield? Current yield is what am I earning today? That is current yield. The term itself explains that it is the current yield that I am earning. Yield to maturity is nothing but what will I earn at the maturity of the term for which the bond was issued. Okay, the maturity of the term for which the bond was issued, what will I get in return? What will I earn? That is determined through yield to maturity. Now let us see the yield of plain vanilla bond. Okay, we will go to current yield. Current yield is very simple formula. We will go to it later. But let us understand what is yield of plain vanilla bond first. Yield of plain vanilla bond, as I told you, a vanilla bond is a bond for which the interest rate is fixed for whatever period it is issued. So let us take the first problem. Okay, But before taking the problem, let us try and understand the formula, that is yield to maturity. Okay, yield to maturity, as you can see, the first value which is taken is the coupon, that is I, which is the interest rate, plus future value minus the present value divided by n. Now, whatever return that we are earning, okay, you are not earning it for the single day, you are earning it for a period of time. So, say your future value is 1100 and your present value is say 1000. So, 1100 minus say 1000, total of 100 rupees is your profit or is your gain. That gain you are not earning for a period of one day, it is for a period of n years. That's the reason why we are dividing it with n. Divided, the whole divided by the average returns, that is future value plus present value divided by 2. So the average returns it is divided by, and that will give you the yield to maturity. Now let us solve a basic problem. A 5-year debenture with 10% coupon rate with a maturity value of 1000 is currently trading at rupees 900. Now, let us find out the I first. The I will be nothing but the interest rate directly applied on the maturity value. It will give you the interest rate, how much interest you have earned, plus future value. Future value is 1000. Maturity value means it is the future value. Maturity value is the value which you will get at the end of that period. Okay, at the redemption you will get that 1000. So 1000 minus the present value, it is currently trading at 900 they have said. So the present value is 900. For how many years is this happening for? It is happening for 5 years. So divided with 5. Divided, the whole divided with the average earnings. The average earning is nothing but the future value plus the present value divided by 2. So the average returns is 1000, which is the future value, plus 900, which is the present value, divided by 2. Now, after solving this, you will get 20. So 100 plus 20 divided by 950, the total yield to maturity what you are getting is 12.63. Now this is the basic way with which you can solve yield of a plain vanilla bond, because the interest rate is fixed for the entire period of 5 years. So you don't have to calculate separately for each year. You can directly calculate for the entire 5 years using this formula of yield to maturity. Moving ahead, let us see for callable bond how you can determine the yield. Now, taking the same problem as before, okay, a 5-year debenture with a 10% coupon rate with a maturity of 1000 is currently trading at 900. But now suddenly the company has decided to call the bond after 3 years at 5% premium. It was trading at a 500, but now it was trading at 5 year, but now the company within a span of 3 years have decided to call it back. Maybe the company does not want to take more loans. They want to repay back their loans and they just want to close it because they feel that it is becoming too expensive for them to pay the interest every year. So they decided to close off the loan. So they are calling back. They are repaying it and they are calling back the bonds. So what is happening over here? Since they are calling it back, they have to pay a premium. Because why they have to pay a premium basically? Since the investor is getting money in 3 years rather than 5 years, the investor is not happy as he won't get the 5 years returns. He has invested thinking that he will get interest for 5 years, but now he will get the interest only for 3 years. That is why the company will have to call the bond but at a premium, because some benefit should be given to the investor as well. So now let us calculate the premium first here. The premium will be calculated on what? The face value. The face value is nothing but the maturity value. So 1000 into 5% is equal to 50. Okay, therefore the premium amount is equal to 1050. 0. Now, the same problem we will repeat when let us do the interest calculation, which is 1000 into 10% plus what is the future value currently now? It is 1050 minus the present value. Present value is the same, that is the 900. The whole divided by 3 because now they are calling it within 3 years and they are not keeping it for 5 years. The whole divided by the average earnings. Average earnings is nothing but the future value plus the present value divided by 2. So the future value is 1050, the present value is 900 and the whole divided by 2. Solve it further and you will get yield to call for 15.38%. Okay, so this is your yield to call. It will become yield to call, not yield to maturity. Though the formula remains same. The formula will remain same for yield of plain vanilla bond and also for the callable bond. Now let us see if it remains same for the portable bond as well or not. It will remain same. So basically the formula of yield to maturity, yield to call and yield to put is the same. Okay, sorry, this will be yield to put. Okay, it's going to be yield to put. Now taking the same problem into consideration, let us solve this problem. So now let us move on to putable bond. Okay, so in putable bond, as I told you, it is a situation where the investor tries to, end the relation between the company. They don't want to lend their money anymore to the company and they decide to take it back. So that is when the putable bond comes into picture. Now, when the putable bond happens, it is usually that the investor is at a good in that situation. So taking the same scenario into consideration, everything is same, a 5-year old debenture with 10% coupon rate, everything is the same story, and in the end the bond is putable after 3 years at 5% discount. Now since the investor had agreed to lend the money to the company for a period of 5 years and they are taking it back before the completion of 5 years, they have to redeem it at a discount. They cannot get the benefit. The investor cannot get the benefit in this case because the investor is taking back the money before the period ends, and that's the reason why that 5% discount is the redemption value which they have to discount it. In the previous case, if you see in case of callable bond, over here what had happened is that the company was calling off the association with the investor. They promised the investor that they wanted the money for a period of 5 years and that the investor will get interest for a period of 5 years for the amount that they have lended to the company. But the company decides to end that and calls back the bond, and that is the reason why this is happening from the company's part. Okay, that's the reason why the company, to compensate the investor, they were giving him a premium. But in case of putable, what is happening is, uh, but in case of putable, what is happening is that the investor, okay, the investor is deciding to, end the relation, and that's the reason why the redemption will happen at a discount. Okay, so discount amount calculation, it will be 5% discount on obviously the face value. Okay, that will be 1000 multiplied by 5%, which is equal to 50. Therefore the discount amount will be 1000 minus 50, which is equal to 950. Okay, so the YTP, that is yield to put, it will be 1000 into 10%, that will be your interest, which is going to be 100 plus 950 minus 900. Since now your future value is discounted, since you are calling off the association between you and the company, and that is the reason why your redemption will happen at a discount. In previous case, if you see, it had happened on a premium, and the normal problem, if you see, the actual maturity value was 1000, but what has happened over here, it has been reduced. Okay, why? Because the investor is calling off the association. So 950 minus 900 divided by 3, that is the number of years, the whole divided by the average returns. So the total yield to put will be 12.61%. Okay, if you see, it is the lowest interest or the lowest returns among all, that is for between yield to maturity, yield to call, yield to put has the lowest return. Okay, so this is with respect to the different kinds of bonds when it comes to fixed coupon. Moving ahead, coming to current yield, I told you current yield is nothing but what we are earning currently, what we will earn today. That is basically current yield. So problem, let us try to understand the problem. Face value of 8% bond is 1000. Okay, and trading currently at 900, find the current yield. So the current yield formula is nothing but the coupon, that is the interest, divided by the market price, that is the price at which it is trading currently, into 100. Okay, so we know what price it is trading currently at, it is 900. What will be the coupon? The coupon will obviously be on the face value, so it will be obviously 1000 multiplied by 8%. So the coupon is 80. So we know the coupon, we know the market price. Let us substitute coupon 80, market price 900. Okay, the whole multiplied by 100 is equal to 8.89%. So this is the current yield. Current yield is a very basic formula. Most of the problems will come from this aspect, and the non-vanilla kind of bonds. The non-vanilla kind of bonds we will see later in the next class. Okay, so that's it for today. In the next class, we will cover the non-vanilla bond returns. Thank you.